So the next hour and a half, we have our annual Q&A. I think you're familiar with the format. Any questions, go. We're happy to talk about how we invest, the companies we're invested in, stuff even unrelated to investing. Feel free to ask whatever you want. And I can't wait to get going. We got Olivia and Tommy on mic duty again. So, who'd like to ask the first question? Paolo, why don't you go? Do we have a microphone now? Oh, thank you so much. Okay, no problem. We've run out of coffee, so either that means there's a lot of you in the room or everyone's struggling to stay awake. Well, let's see if we can get the mic. So it's just up the front here, yeah. And then whoever wants to ask the question after Paolo can maybe grab the second mic.
Okay, thank you, Rob and Andreas. Thank you, Rob and Andreas, for setting up the meeting. It's always a great way to see friends and to learn things. I'm going to ask you two questions about two companies. One is Interactive Brokers, and the other one, Credit Acceptance. I would like just to have your view at the present time, how they're doing, and how do you see them?
Yeah, I would say two. So the question was about two of our investments, Interactive Brokers and Credit Acceptance. And so for those of you who are perhaps less familiar, Interactive Brokers is the leading platform for trading stocks and options. Very successful company. We've been invested for several years. And Credit Acceptance is a sort of I would say if Carvana's the sort of the new world, is sort of the old world of subprime lending for purchasing a used car. So I'd say I'll try and keep my answer short so we can get through lots of questions. They're obviously big topics, but I would say, contrasting fortunes for both companies. Interactive Brokers today is growing like an absolute weed. Every month, it seems to grow its customer base by about 2%, and if you sort of compound 2% per month for 12 months, you get to very big numbers annually and even bigger numbers over time. So that's a business which just has an incredible runway ahead of it, and also, I think very strong competitive advantages. It's the low-cost player. We were comparing it to some other online brokers recently. Its prices sometimes are a tenth of those of its competitors, and yet despite that, it has a 70% EBIT margin. So, it's a business with a wide moat, a big opportunity, and we're very excited about that. I'll let Andreas chime in on Interactive Brokers, and then we'll go to Credit Acceptance.
Well, I'm also a big fan of Interactive Brokers. I've been a customer since 2007 or so, and I cannot imagine, we wouldn't know where to go to if Interactive Brokers didn't exist as a business. And I think it has a huge runway to grow. They have the best product in the industry, I think, and they have just 4.5 or 4.4 million customers, and I can easily see them 10 times as large as they are currently. They are constantly working on the product. You really see progress, and it's really exciting to watch this story unfold.
Yeah, and we're big users. A lot of the investors in the business owner fund hold their shares with Interactive Brokers. So I think we're a meaningful, an insignificant source of new customer acquisition in terms of number of customers, but some pretty sizable customers nevertheless. I wonder, is Toma Montanari here in the room today? There is. Toma, why don't you stand up? And a round of applause. Toma represents Interactive Brokers. Yeah. He's responsible for getting us Thomas Petterfee next year, so no pressure. And then Credit Acceptance, I would say, is sort of a contrasting story, a company which has always had an incredible moat. For those of you who are unfamiliar with it, it's sort of, its big innovation in subprime lending was really to create alignment between the dealer and the used car buyer by sort of allowing the dealer to participate in the upside of a loan if it outperforms. So, the way Carvana solves that problem is by being completely vertically integrated. So, they basically stand with their brand behind the car when they sell it. The way Credit Acceptance solves for that is by effectively incentivizing the dealer, whose incentives, especially on a one-time transaction, are probably not to give the best deal to the customer, is to make it so that there's very strong alignment. And so I think it's a wonderful business with a very wide moat. If I look at the last sort of 5 years, though, I would say, we've held the company for about 10 years. I would say over the 10 years, it's been a great investment for us, and we love the people that work there. We love the business, and still big believers in the future. I'd say the last 5 years, though, the business has struggled a little bit. I think some of that is for reasons beyond their control. We had some very weird things happening in the market with COVID, where there was a big drop in default rates, which meant earnings sort of spiked up. And then when things reopened, and you had this huge car price inflation, which made cars very unaffordable, or things in general unaffordable. So then you had a situation where default rates went up a lot. That was 23, which I think for Carvana was, or for the whole industry was an issue. It wasn't just for credit acceptance. And so, it's been a weird couple of years, but I think they've also made some mistakes which were homegrown. It's a company, oftentimes companies' greatest strengths are also their greatest weaknesses. It's a company which is incredibly focused on economic value added, on being frugal, on being efficient, and of course, in most contexts, that's a wonderful thing. But I think they have underinvested in their IT over the last 5 years, fallen behind competitors like Capital One, probably Carvana as well, which has a very, obviously a much more sort of fluid customer flow if you're buying and financing a car. And so, but to their credit, I think they recognize that. They've reinvested a lot in the business and in the IT, and they're just in the process now of rolling that stuff out. So I'm very optimistic for the next 12 months. For sure, they've underinvested in parts of their business for the last few years. Yeah. Anything you want to say on it?
I think Rob knows the business inside out. There's nothing I can contribute there.
Yeah. I mean, sometimes the question I get is, why would you own Carvana and credit acceptance? I'm obviously incredibly excited about Carvana's future, but I think in the next 5 years, even in a best case scenario, it will be 3 million cars in a 45 million market. So there's still plenty of room for other players to participate in this market. Yeah. Yeah.
Rob, question on Carvana. Mm-hmm. The absolute valuation of Carvana at the moment is very high. Can you summarize your assumptions for holding a 20% in your fund, a 20% position in Carvana?
Yeah, I mean, I think just to maybe back up a bit, I think I view myself as a value investor in the sense that I'm trying to buy future streams of cash flow for less than they're worth. And I think historically there was this idea that you can only be a value investor if you sort of pay very low multiples of current earnings or pay below book, or Ben Graham, of course, most famously, with the nets and only paying for less than the working capital in a company. And what I've come to realize is, that type of company, which is sort of trading below book value, has a very, very low multiple. Oftentimes, it's a below average business, probably capital intensive if it's carrying a lot of capital. I think I've evolved, and I think a lot of value investors involved, is to think more expansively, not just in terms of what is a company earning today, but in what is it going to earn in the really long term. And I don't want to go too much into the weeds here, but I think the assumption on Carvana is in the short, medium, and long term, there's just so much opportunity to grow. Today it's growing at over 40% per year in terms of the used cars it sells. Obviously, that's not a rate that's sustainable forever, but I think Ernie and his team are going to do their best to keep that going for as long as possible. And 3 million is not the end of the road once they get to 3. It's a business which keeps getting better with scale. There's all these kinds of positive feedback loops. So I think it's a business that will continue to grow after that. And if you assume that they're going to make even this year, next year, roughly about 3 billion in EBITDA. A lot of that converts into cash because they have tax loss carry forwards. A lot of the capex has already been spent on the existing IRC network. So, 3 billion compared to where we are today, I don't think it's a high valuation, but I don't think it's a crazy valuation.
Yeah, I may add a few high-level thoughts. We have seen many times that companies that go through a crisis emerge much stronger than they were before, and I think that's absolutely true for Carvana. And it's not the same business it was 3 years ago. So a 20% allocation today is not to be seen in the same light as a 20% allocation would have been 3 years ago. So it's a much stronger business, much more profitable business, and a business that has a really long growth story ahead. So even if the valuation currently looks higher than you feel maybe comfortable with, I guess that if you, similar to interactive brokers, if you have 10 years of growth ahead, then that corrects for a lot of the high valuation.
Who wants to go next? There's a microphone.
1 year ago, I couldn't imagine moving our company website from Wix to an AI website builder. Last week we decided to move. Switching costs disappeared completely. You wrote about Wix in your half-year letter. I'm wondering, since then, since the progress in AI, how did your thoughts on that part develop?
Yeah, I mean, it's something I'm very alive to. I think when the AI boom, so Wix is a website building software. We use it for our own website where everyone here registered for the meeting. And, I think one of the very earliest sort of demonstrations of AI was someone sort of showing us sort of building a website using AI in a few seconds. And so I think right from the beginning of this sort of revolution, there's been a sort of question mark, is that type of business disrupted by AI? I keep an open mind about it, so more than happy to change my mind if the facts change. But as of today, I just don't see it. First of all, I think building a website very quickly is, especially if it's a simple one, is a solved problem. I think AI is great where it's something which might otherwise take you many, many hours, imagine to summarize a book or a document or something like that. There, the delta between what a human would do and what the AI can do for you is incredible. But with in terms of a website, building a website, if you want to with Wix today, you can build a site, in a matter of seconds. So. I think in many ways AI is actually a tailwind to the business because it helps you sort of put the text together more quickly. And that's not to say you can't build a site on your own, but then there's always the question of where do you host it, how do you keep it up to date, how do you keep it secure, how do you add more kind of complex sort of functionalities like registering an event like this one. So as a practitioner and someone very, very close to both the business but also as a user, I don't see that disruption case today, but I'm happy to change my mind if the facts change. Yeah.
There's certainly a lot going on in this business, and so one concern is certainly that chat agents like ChatGPT sit at the top of the funnel and may suggest building some website for you, and you don't even get to Wix it that way. But then again, Wix could partner with ChatGPT and other chat agents and get a lot more customers that way. So it can cut both ways, and if they're smart about it, they will emerge bigger than before, and the websites would potentially be more complex than they used to be. So it's more people will have websites because the barrier to entry has been lowered, and they will have more complex websites. And if Wix focuses to have the best toolkit to build a website with, it could still work for them.
Yeah. I mean, one of the biggest barriers they have to grow is not finding customers; it's converting them. And the reason customers sometimes don't convert is they're just technically not able to complete their website. So any technology that makes it easier to complete your website is actually a tailwind for their business, I would argue.
And by the way, they are also including AI to build websites on their own platform. They are not just relying on external AI, but if you go to the website, if you go to Wix.com, you can now create a website using AI, and even better in the future. So the barrier to entry is certainly lower, and that may increase the business size even. I mean, it's not conclusive what the outcome would be.
The market seems to have made up its mind, but we're more open-minded about it, I think.
Yeah.
Okay. There we go.
Hi. How do you think about process when the way the management seems to be doing to unlock the discount is to diversify away from Tencent and growing operating earnings. Do you still think it's a good proxy for holding Tencent?
Yeah, so Prosus is a Dutch holding company which was spun out originally from Naspers, which is a South African newspaper group, and they recognized very early on in the early 2000s that newspapers weren't going to be here forever, and sort of started building these venture capital portfolio, and they bought a very substantial stake in a then very tiny company out of Shenzhen called Tencent, which is now one of the biggest companies in the world, and to their credit, kept the stake through all that time. I think even still today, they own around 25% of Tencent. And the reason we're huge fans of Tencent in terms of the business, the people running it, but historically we've owned it via Prosus. We're not, to be honest, big fans of the Prosus management, something I'm happy to talk more about. But the rationale to own it through Prosus is Prosus trades at a very large discount to the value of its assets, and buys back its own stock very, very aggressively. So on our sort of back of the envelope math, just by, they buy a very, roughly 10% of their stock back at a 40% discount every year. And so, you're getting a sort of a 4% uplift versus whatever Tencent is worth every year just through that. So that's historically why, we prefer to own it through Prosus. That said, it has a new management now, which seems much more ambitious about deploying the company's capital, less in share buybacks, more into other directions. That's a trend we don't like. We're not fans of the Prosus management as allocators of capital, and so that's definitely something to think about. Whether at some point we should make the switch to Tencent. Yeah.
I have nothing to say. Yeah. Rob has already said everything.
Yeah, I think a dearly beloved friend who was sort of coming to some people's mind who sadly passed last year when you said that. But we'll stop any analogies there, because whenever a fund manager make analogies to a certain person in Omaha, that's when their career tends to nosedive. Yeah, I think it's like the equivalent in theatre is if you talk about the Scottish play. So yeah, we won't talk about the Scottish play here.
Hi, Chandan here. Thank you, Rob and Andreas, for having us every year. The relationship also compounds, and it's great to be here every year and build on those. I wanted to quickly talk about Salesforce and the revenue and the pressures. I have some unstructured thoughts about it. One is the seat-based model. If the number of employees shrink, how does that impact the revenue of the company? And the second one is if folks move to AI-based work streams, then that also basically becomes a cost to them. Like every query costs now much more than before. So wondering what your take on it is. Thanks.
Andreas, why don't you take that when you're on
sure.
Salesforce?
I think I didn't acoustically get every single part of the question, but it was about Salesforce and how AI would impact them. And so the one impact is certainly the seat-based pricing model. If you have fewer seats in sales and service, then you will generate less revenues, and it's certainly a headwind that they have, and that they try to compensate by creating the agent force and the data 360. And we will see if they can compensate that in full. But in general, if they can create more value for the end customer, then some of that value they should be able to translate some of the value into pricing. So maybe they will charge for conversations on the agent cloud, things like that, and compensate the lower number of seats. And the people who who operate the lower number of seats would be more productive. And if they're more productive, then as a result of the agent cloud and as a result of some assistance that Salesforce operates on the platform, then they can also charge more per seat. So I'm generally optimistic about software companies in an AI world if there is no clear path to disruption, and I don't see it here. I mean, maybe they will suffer a little bit on with the smaller customers, but I don't see someone building a big enterprise CRM system with all the regulations around it.
Yeah, I can hear a tiny bit of feedback. I don't know if there's anything we can do about that, Achim. But yeah, I would maybe just sort of chime in there. You know, I think it's a strange bear case that, you know, software is going to create way more value for the customer by sort of doing away with the sales force, and as a result of that, the software is going to earn less. I think in that world, the software is more valuable. What I would say my longer-term concern is more like, you know, obviously a company like Salesforce is built on the idea of humans doing the selling. And, you know, increasingly, I think AI is going to be doing all kinds of different tasks, not just selling, and probably a software which is, you know, CRM software which is built on that assumption will probably be a more efficient one, and the companies that are also built on an AI assumption and maybe do better than some of the sort of more traditional companies, which would be Salesforce solutions. But, you know, that feels a long way away, and, you know, there's definitely strong arguments where AI is a big tailwind to their business.
Yeah.
Yep. Okay, who's...
there was a small, if I may, there was another question which was about the queries becoming more expensive. Like adding an incremental customer for Salesforce right now was pretty much free. But when you run sort of queries which are much more expensive in terms of running them, does that also...
So I don't understand the question. Can you maybe just...
So if you run a query through AI, that costs a lot more money than what Salesforce had so far. So does that impact the margins in some sort of sense that you think of?
Oh, I don't think, because it creates a lot more value. I mean, I personally think that there is a bit of an investment bubble in AI because people scale an immature technology to a degree that the technology is not yet made for. There will be innovations that bring down the amount of compute that is needed in the next years. So maybe it could impact the margins of a business like Salesforce in the short run, but in the long run, I would say that there are way cheaper ways of doing inference than we are doing it now.
Okay, thank you, Chandler. Who's next? Maybe here, and then Claudine afterwards.
It's Omar. First of all, thanks for hosting every year. Conceptual question for the both of you. How often do you go back to old ideas as potential investment opportunities for? So, for example, for Rob, you used to own Novo Nordisk, right, for a while, and I think you lamented selling it too early, and now it's come back to earth, of course, because of all the issues. How, and again, you don't have to go to that specific example, but just how do you think about your old portfolio as a concept for new ideas? And same, sorry, I'm not as familiar with your portfolio, but same question.
Mm-hmm. Yeah, no, I mean, I think for me, the ideal case when I invest in a company is I've known it for a really long time. You know, I don't like the situation where I sort of potentially see a company, be very excited about it, and then make an investment, you know, a few weeks later. You know, I think you get a lot of information and you know, confidence in investment by following it over time, seeing whether people do what they say they're going to do, getting to know the character and all this kind of stuff. These things are all very big factors for me. So in that sense, you know, if there's a company which I've known for a very long time, perhaps even owned at one point, then that's for sure like a very fertile place to look. And yeah, so I'd be very open to investing in a company which I've invested in the past, yeah. How about you?
Yeah, I agree that knowledge builds over time, and comfort and conviction builds over time. And I have owned several companies for the second time, which I maybe sold for valuation reasons. But later, when the valuation became more reasonable, I bought them again. And I think that's a good thing to do, because the probability that you are wrong on an investment that you have known for a long time is a lot lower. And for that reason, the expected return of the portfolio goes up if you make fewer mistakes, if you can avoid a mistake because you know the investment very well.
Yeah, thank you. Claudine?
Hi, thanks. Hi. Hi. Nope.
Oh, is it muted or?
Hi. Yeah.
Yeah,
Thanks.
got it.
I was curious about how you see the competitive landscape for Meta, because on the one hand, there are more alternatives for the use of people's time and attention. So apparently, younger people spending more time with chatbots and so on. The fact that they're no longer such a social network, you've commented on that before. Mm-hmm. And third, I can just imagine the announcement that ChatGPT takes advertising, so advertising dollars might be spread around. So how do you see the risk, the competitive risk for Meta going forward?
Yeah, you sort of summarized maybe some of the sort of risks or downsides there, but there's of course a lot of sort of opportunity comes from AI. The business sort of really took a hit in 22 when Apple introduced its ATT changes, and Meta was one of the earliest companies to start using AI to improve its sort of data, to improve ad conversions, ad attribution, and the growth the companies experienced since then has been absolutely incredible. So I think there's lots of opportunity there, and the risk is when you only sort of focus on when you focus too much on the risks, you end up thinking, oh, this is all very difficult and stuff. But and then maybe leaves you with an unnecessarily pessimistic situation. But specifically to sort of new sort of form factors, new competitors coming up, I think that's something we've always seen. There was Snapchat. Back that was probably when sort of 6 or 7 years ago when they had a lot of success with stories, and then more recently TikTok with short video. And even though in particular TikTok has been very successful, won a lot of user engagement, Meta has still continued to grow and have a really good business. So. I expect ChatGPT it's very tough to build an advertising business, but they're obviously they're going to make a start, and as they should do. But I think it'll be a long time before their ad tech is even remotely competitive with Meta's, and despite irrespective of that, the market seems to have a lot of room to. People have more attention for their mobile phones than is probably desirable or healthy.
Yeah, what I like about Meta is that they do not try to sell AI on a standalone basis like maybe ChatGPT does, but they have existing products, they have customers, they have data, they have all in place, and now they can improve what they are offering, and therefore have a much lower risk of succeeding in that space. And of course, yes, ChatGPT, if they sell advertising, it would be just another competitor. I remember lots of people were worried about Google when Amazon started selling advertising, and then Netflix started selling advertising, and now it's ChatGPT. It never had really an impact, because as long as they get better at targeting and can prove their conversion reasonably well, I think they will be able to sell the advertising space.
Yeah, I think the important thing to realize is they really increased the size of the pie. You notice that when there was a boycott of the big sort of FMCG bans a few years ago, there was this sort of idea that because Nestle was going to suspend advertising with Meta, that it would somehow damage its business. But the reality is there's millions of companies that advertise on Meta. It's an auction-based system, so if one person advertises less, there's millions of other companies more than happy to bid on that space. And so, it also creates a lot of businesses which would otherwise not exist. In a pre sort of internet world, you had basically the choice of reaching customers, via TV if you were sort of like a big sort of national brand, local newspaper for maybe more of a sort of local business, and then maybe pamphlets for an even more smaller business. But there was of course never any scenario where a business advertising locally in one city would ever be able to reach a customer in a different city or even a different country. Whereas what you see with Meta and other ad platforms is now you can have some a grandmother in New Zealand making a kid's jumper with a sort of special New Zealand wool and selling it to someone in Europe or wherever. So these are businesses that would otherwise not have existed, and And I think it's also a reason to be optimistic about, people are very alive to the risks of the internet and social media in particular, and there's definitely with some justification. But we shouldn't forget that a lot of businesses wouldn't exist if these adverts didn't, weren't there, and if the customers aren't there, then there would be no jobs. So, society as a whole would be much poorer and much worse off if there wasn't the means for companies to find their way to customers. So, I'm pretty optimistic. Yeah, Marcus.
Just a question on your structure, maybe of the fund. Mm-hmm. Maybe, hopefully, not too boring for all the others, but nevertheless, keen to hear. Thinking of it's the wrong word, I know, of your investment process and also on your structure is. You're quite big fund in the meantime, and you still have, with I think is exactly the right thing. You are very focused, so with 10, 11 stocks, but you keep them for a very long time, as you mentioned. So what does it mean for the future? Do we have to think about or have to assume that will stay for the next few years, or is there also an opportunity for you to say, let's go to 15 investments in your fund? Is it something you could think of? And maybe one or other questions in that respect. How do you see opportunities right now? Are there more opportunities right now for you to invest in compared to, let's say, 2 or 3 years ago? How do you see the situation, and where could they be? Is it in the recent years we see more from the US and maybe also some Chinese investment? Is there also an opportunity for, let's say, investments in Europe, or is that something you are not really looking at because you say they are too mature and the new companies are too small for your fund? So maybe some color on that maybe.
There's about 4 or 5 questions in there, so I'll try to keep my answers short, and if I miss one, then please excuse it. No, I've always invested in a concentrated way, as has Andreas, and that wasn't for any sort of ideological reasons. It was because when we started, we didn't have a lot of money, and when we had like a really good idea, we wanted it to move the needle on our net worths, and that's how we started. 2 of my dearest friends are in the room here, Vidar and Wolfgang. We shared a room together, and we were in the dot-com bust of around sort of 2001, 2002. We were buying all these sort of shares of micro-cap companies at below their net cash, and there was some incredible opportunities, but we love to really bet big because those type of good opportunities don't come along very often. And then fast forward to and that's the way I invest the way I do, and then fast forward to when the fund started in 2008. An important mentor for me, Norman Rentrop. He only gave me one piece of advice when the fund started, and he said, "Rob, don't change anything. Just keep doing things the exact same way you've done it up until now." And that was great advice. If you become successful doing things one particular way just because the structure changed or you become more successful or something else, there's no reason to change things. So it will for sure stay concentrated. And then, what was the next one, which was sort of related to that?
I think it was the opportunities you see at the moment.
Yeah, okay, so opportunities. Did you want to say anything on the concentration?
Yeah, on the concentration, I'm not really sure we're religious about this 10, about this number of 10, but I have always felt that there was not a huge number of good ideas at any point in time, so it was difficult enough to fill the 10. But if this changes and there are lots of opportunities that we can easily understand, I think it could also be 12 or 15, but certainly not 50.
Yeah. Sometimes we might buy multiple companies around the same theme just because of liquidity sort of considerations, but we would view that as one sort of investment decision. And then in terms of the opportunity set, the market's always fascinating, and every quarter I have like 4 or 5 new investors come into the fund, and they always ask me, it feels like a tough time at the moment. What do you think about it? And my response is, it's always like that. Apart from every now and again, you have something like the COVID situation, or after 9/11, where things really go into free fall. And then, of course, the opportunities are amazing, but then there's sort of all kinds of other things happening which make it difficult. So it always feels like that. But that said, I'm not especially pessimistic at the moment. Everyone talks about an AI bubble. But there's very few listed companies which are actually, directly AI related and theoretically in the bubble. There's obviously companies like NVIDIA, which are very, clear beneficiaries of AI, have very high valuations. I have no idea if too high. I leave that to other people to figure out. But apart from that, there's actually not many companies. What there is a lot of companies are companies whose stock prices have been absolutely crushed because they're viewed as AI losers. So, in the public markets, I think it's more relevant probably to talk about as sort of like an AI sort of depression as opposed to an AI bubble. And we especially in the software space, we see quite a lot of opportunity. Constellation Software, for example, we're not invested in it, but it's a company we've admired for many years. And I think last year it lost about 40% of its value. It's trading on around 20 times earnings today, and you basically see that across the board with software companies. So, don't have a strong view. I'm not saying that's a great opportunity, but for all the people talking about an AI bubble, I would also point to some AI depression out there.
Yeah, I second that. I think there may be some excesses, let's say, about the depreciation periods of AI equipment that some cloud companies have in their balance sheets. They are currently at 6 years, and I think the GPUs will not have the same value or will not linearly depreciate over 6 years, but will maybe lose 50% of the value in the first year. and the technology will be progressing very fast, so maybe there is some overstated earnings. But then again, if inference got a lot cheaper, which I think will happen, then those companies will have a lot less capex and more free cash flow, so that would be maybe even a net positive for them. What I can see is that more AI will move to the local machine, and that could pretty much render many of the big data center investments excessive. But we will see how that pans out. I'm aware of that risk, and I think we're discussing that all the time, and we are checking each one of our investments, how it will fare under such a condition.
Yeah, I think there's a bear case on Meta that they're overspending on data centers, but it's not something I lose sleep about. If they build too many data centers, then all that means is their capex will go to zero for a few years as they sort of grow into that capacity. So. I don't think that's a great bear case. Yeah.
Or they will have to invest a lot less if they build out newer technology. There was a lot of bearishness around Alphabet, Google, that they said either they will lose the market to ChatGPT, the search market. In this case, they will lose, or they will not lose it to ChatGPT, but they will no more have 99% gross margins. They would have much lower gross margins because of all that AI equipment. And now it may turn out actually that AI equipment could be a lot cheaper if newer technologies are developed, and maybe the gross margins will also be preserved to an extent.
Okay. Did we manage to hit everything there, or did we miss anything out?
Yeah, that was more or less a bunch of questions.
Yeah, I think there was one about Europe. Just very briefly, so we get other people to give a chance. We're very pessimistic, to be honest. We're very pessimistic about Europe, with maybe the one exception of Scandinavia, where you see a lot of new company formation, a lot of innovative startups. But we see almost no innovation in Europe. It feels like a lot of the sort of the tech developments are being driven by the US. A lot of the manufacturing innovation is coming from China, and it's not clear to us how Europe fits into that picture. We're micro guys. We're equally happy to invest in Europe or anywhere else, and frankly, as someone living in this region, I hope Europe does well. But we just see very few new growing businesses either list on stock exchanges or existing business with good growth. So. We're pretty pessimistic there, but very much hope to be wrong about that.
Yeah, we're looking at European businesses all the time, just we're not finding much there. And the number of listed companies in Germany, for instance, has gone from about 1,000 to 400 now over the last 15 years.
Yeah.
So the pond is getting smaller and smaller.
Yeah. so many hands. Who's got the mic? There we go. Yep.
Firstly, thank you, Rob, for the invitation and for bringing us all here together. Just following up on the question about concentration, I wondered if you could talk to us a little bit more about your framework for managing the portfolio within a concentrated fund. For example, where you have new AUM coming in, but a limited number of positions, where, for example, one position is 20% of the fund, and let's just say that doubles during the course of the year or perhaps triples, but the rest of the portfolio stays the same. What's the framework that you use from a portfolio management perspective? Just be keen to hear your thoughts more on that, and Andreas as well.
Yeah, I think we're probably not a little bit unconventional in that respect as well. I guess the way a sort of an institutional manager would do it is, if to the extent there's an inflow, it just sort of pro rata or to all of the existing positions. We tend not to have huge inflows that really sort of shift the whole portfolio. But when we do have, a typical inflow for us will only be maybe 1 or 2% of the assets, if that. And what we'd typically do is not just say, okay, let's put it equally into all of the existing positions. There's normally one company which we're a little bit more optimistic about, where the share price happens to be maybe down, or the perspective seems to have improved a lot and the market hasn't caught up with it. So we typically put new capital into what is at that point our best idea.
Yeah, and as to position sizing, I think we just look at the risk of each position, we look at the valuation, and then think about how big it should be. I think the fund is not a fund where people typically put 100% of the net worth in. So people will have to sustain quite some volatility in the fund. But we try to not to mess up.
Yeah.
So I mean,
it is a very concentrated portfolio, and if ever a company were to go to zero, in a 10-stock portfolio, it'd be a disappointment, but it'd be something we could recover from. And I'm happy to say that coming up almost 20 years of doing the fund, there's never been a company that went to zero. Carvana was flirted with that level for a very brief period, but I'm happy that worked out very well in the end. Not every investment we've ever made has worked, but none have even come close to being disasters. Yeah.
I admire Rob for his conviction regarding Carvana to ride it out when it went down by 99%, and but that comes also from concentration. So, I mean, if you don't concentrate, you don't know your positions as well, and you will never develop that kind of conviction to hold such a position in a situation of stress. So I would say that's also fits into the whole risk management approach, not just position sizing, but how well do you know your positions and how much conviction can you develop?
Yeah, and people develop conviction in different ways. Some people do it through being sort of super deep in the weeds, sort of analytically. The way I do it is, I try to be as analytical and diligent with my research as possible. But for sure, there's people who go even deeper. But what I think about a lot is the people running a business, and whether I trust them. And even at the darkest days of the Carvana situation, there was one thing I was sort of completely sure about. And that was, the character of Ernie and his motivation. I thought the chances were excellent that he would turn things around. But I was alive to the possibility that sometimes things don't work out as you plan. But the one thing I was completely certain about was that he would give it his best shot. That to the extent he wouldn't sell out. The minority shareholders, and if it didn't work out, it would be not through any fault of him or the team from trying. And that's not just something I say now. That's what I wrote in my letter back then. And it gives me a lot of pleasure to see that vindicated, and it gives me a lot of pleasure as well to have Ernie here today. So thank you for that. I think there's a microphone there, and then do you have the microphone? Okay.
Any luck?
Yeah, I think we can. I think people are muting it after they ask their questions, so you might just need to switch it back on afterwards. Yeah.
I need a young person. person to help me with it.
I know the feeling.
Thank you. As software investors, how or do you guys keep up with state of the art in AI? For example, have you vibe coded a website with Claude, or have you done stock research with Notebook LM or other sources?
Yeah. Why don't I let you go first on this? Because Andreas, amongst many other things, is a very talented programmer, and actually his first commercial enterprise was writing a book on programming, which he famously says was not a commercial success. We did a mountainside interview. So, but you do a lot of programming, so why don't you talk about your experience?
Yeah, I mean, we look at all the tools, we try them and test them, and try to program some scripts with it, but you have always got to understand what you're doing. You cannot just let the AI go ahead. So whether it be in investment research or in programming, and what I also do is I try to read papers on AI, so new things being published. So where is it going? And that gives me quite some conviction that we are going to smaller models that we may run on a local machine rather than the huge models. And yeah. So you develop a view of the world and check how your investments fit into that view, and so.
Yeah, and I think there's lots of directions we could take that question, but like the moat of a software company was never just sort of like actually making the software. There's all these sort of switching costs and network effects and APIs and interactions between the software. So, the idea that you're just sort of going to sort of ask a vibe coding app to replace the software you're using, I don't think that's realistic. I mean, for many software companies, it could, especially like some of these older software companies where maybe a little bit behind on updating the software, but with good customer lock-in, AI tools could help them to get their software up to date more quickly and more cheaply, so it could actually be quite a good tailwind even for them.
Maybe a few words on the cheapness. I mean, there has been free open source software around for decades, and if people want a free CRM system, they could have gotten it already years ago. There are such systems around, and nobody is forced. Yes, they are pretty good, and nobody is forced to use Salesforce and to pay the price of Salesforce, but people still do it. And if it gets cheaper to program through some AI assistance, then I don't think it changes that much. And the question is also, I don't quite see that you just punch in a prompt and you get a ready-made piece of software. This only happens with very simple software, but you have tons of bugs in there and tons of security holes, and you still have to architect the whole system. You can only code small parts of it, and you have to think about the entire architecture all the time. So it has to fit together. And
I'm not a coder, so I can't speak to that side of things, but I use it a lot for research and for investing, and I have to say it makes my job much more fun. It used to be, like the way my workflow used to be, if I was looking at a new company, I'd open up the 10K, and there'd be a lot of time just lost scrolling through it, going through all the sort of the boilerplate stuff which isn't relevant, trying finally to get to the bit which explains the business and the market and all that kind of stuff. And it's just incredible now with AI tools how you could just sort of like ask all these sort of simple things. What does the company do? How does it sell? Who are the customers? That, and then you get very, very good answers back very quickly, and it helps me to get up to speed much more quickly. And I think Ernie made the point earlier. That's all very well, but if everyone else can do that, then where is your edge? And I think, at least for us, our edge isn't being smarter than other people or quicker to the trigger or anything like that. I think it's about temperament and being willing to act when opportunities present themselves. And I don't think AI will make that any easier for people who don't have the temperament for it.
Question here, Rob.
Okay.
Can you hear me? So thanks again for organizing this, Rob. And so 1 year ago, we had on stage Will Lundin from International Petroleum Corporation.
Yeah, what a guy.
Yeah. And so returning to that, I was thinking, what are your views on the company now? On two main things, I would say, capital allocation and business economics now. For instance, the cost of production and what has changed in the last year. Thanks.
Yeah, so we were privileged to have Will Lundin here up on stage last year. He's the CEO of IPCO, International Petroleum. And IPCO, if you're not familiar with it, is a company that develops oil around the world, but primarily in Canada. And a year ago, there was, the share price was very cheap. And there was, I would say, a certain amount of pessimism. They have this very big new project developing one of the first thermal plants to develop heavy oil in Canada, which be one of the first greenfields for many, many years, maybe even decades. And so there's a lot of pessimism about whether that can be done, whether there'd be cost overruns, whether it would take longer than it would do. And that was also, I don't think anyone sees like an energy or an oil expert sitting in front of them here, but I was and still am incredibly impressed by Will, his energy, the dedication of the people that work for him. Actually, lots of very similar things to what I see at Carvana. And without being the world's greatest expert on energy, I was pretty sure he would deliver that project on time and on budget. And fast forward 1 year to today, and the share price, I think in US dollar terms, has almost doubled from that level, even though the oil price is down very substantially. And I think that's because a lot of the pessimism about that project has dissipated. But of course, an investment, when if the price is up a lot and the oil price, which is of course the main determinant of their revenue, is down, that for sure makes it as an investment opportunity less interesting, today than it was a year ago. Yeah.
Thanks.
Pleasure. Do you have a microphone? Maybe we can get a mic, get one there, and then this gentleman here has had his hand up several times, so maybe you can get him for the next one. Yeah. Not that one. Just here. Yeah. Philip.
Maybe I try it like this.
I can repeat the question.
Could you give us an update on your Chinese portfolio ex-Prosus?
Mm-hmm. So the question was for an update on the Chinese portfolio ex-Prosus. As many of you will know, I do annually what I call a discovery tour to a completely new country, just to sort of meet the people there, meet some companies, sort of get the lay of the land, and sort of plant a seed which can potentially lead to an investment in the future. And sometimes those trips lead to investments, other times they don't. But in the case of, and I've been doing those trips every year now for probably almost 15 years, most of the time with my very dear friend Richard, who I'm not sure if he's here yet, but there he is. Round of applause for Richard. And that's probably a lot of pleasure. So we did our first trip to China together, probably either 2011 or 2012, when we had an investment in Baidu, which was then, the hope was it was the Google of China. That didn't quite work out, but we went to the Baidu world there, and since then, apart from the COVID hiatus, I've been traveling regularly to China and visiting the companies there, forming friendships with people, and that's resulted in some investments over the years, primarily in Prosus, which is a sort of proxy for Tencent, as we discussed earlier. But a situation developed a year ago where the pessimism around China just reached an absolute sort of crescendo. There was sort of the prospect of a Trump presidency and of tariffs, and the economy was in a pretty bad way. And there were all these statistics about how the stock market had been down for the last sort of goodness knows how long, 10 years or more. And, I think some analysts are writing reports saying the stock market is uninvestable, which doesn't strike me as very smart if you earn money by talking about the Chinese stock market. But anyway, it's always a good sign if people are talking about a market being uninvestable. And but anyway, so I knew the market pretty well, and I knew a lot of companies there which I admired. Pretty much all of them founder-led, I would say. It's a younger economy in China, so oftentimes the companies are still run by the first-generation founder. And there are a lot of companies I admired and liked. I knew prices were absolutely crazy cheap. But I also knew that I don't speak Chinese, I don't live there. I knew there's probably 1.5 billion Chinese people that know that market better than I do. So the approach I took was to invest in, I think it was around 4 or 5 companies with a smaller allocation than I would normally, but viewed as a block, including Prosus. came to roughly 30% of the portfolio. And I think, I hope I'm not misspeaking, but I think all of those companies have really done incredibly well. Probably the two that did best were Yum China, which is a sort of owned the KFC franchise in China. We also have an investment in a hotel franchising company called H World, one of the largest hotel franchising companies in the world. Not particularly well known outside of China, as its business is primarily in China. They've done incredibly well. The prices were very low. There was a lot of pessimism about the consumer, and the sentiment, still not great, but has improved. So the sentiment has improved a lot, and the earnings expectations have gone up. So it's as of today, it's worked really well. And China's a place where I think we're going to be investing for a very long time. It's very badly misunderstood. I think in the West, like any place, it has its faults and its problems, but it's also some incredible entrepreneurial energy there. And even today, the valuations are still very low. So there'll for sure be more investments from China in the future. Anything you want to chime in on that?
No, I agree with what you said.
Here we go.
Thanks a lot. Test.
I think it's working, yeah.
Okay. You have been talking earlier about the opportunities in Europe, and you have been in the past an investor in Novo Nordisk. This weight loss space is a pie that is probably going to grow a lot in China, in the US, in Mexico. And so the PE is very, very low in comparison with the other American companies, like, for example, Eli Lilly. Do you plan to, or you are thinking to go back in the space? And what do you think in general about the current price on Novo Nordisk?
Yeah, well, this is the second question we had about Novo Nordisk. So I don't know if anyone has any sort of secret insights into my portfolio, but I think I teased in Q3 that I'd added one new company to the portfolio, and it was indeed Novo Nordisk. I wasn't planning on talking about it today, but as it keeps coming up, it seems unfair not to. But that was also a company which probably less than a year ago was the most valuable company in Europe, flying high, and $500 billion market cap, and it's just incredible the change in sentiment over the last sort of year. I mean, the company for sure has had missteps. It became complacent, and particularly when things are going well. It's actually interesting to compare the situation with Carvana and Novo Nordisk. So if you were to go back sort of a couple of years ago, Novo Nordisk flying high, everything's going great, and it looked like a company which the adults would own. And then you had Carvana, sort of a little bit in a crisis, share price at rock bottom. Looks like they're the sort of the casino, the sort of the gamblers were owning. And actually what you find is actually when companies are doing very, very well, it sort of sows the seeds for sort of complacency and for future sort of inefficiencies. And the exact opposite happens when a company's in crisis, that everyone rolls up their sleeves. And oftentimes it's better to be optimistic when a company's in crisis, even if the immediate data is negative. And I think that's what we see in Novo Nordisk. It's still a very, very good company. It's for sure made some missteps, which Andreas maybe wants to talk about. But we think the price, the pessimism got way too excessive. At the end of last year. But
yeah, well, the valuation of Novo Nordisk is obviously a lot lower than Eli Lilly, and for good reason, because they have lacked innovation in the more recent past, and their pipeline is not as well positioned as it could be. I mean, they
hired too many people. They were slow on registering drugs.
They relied too much on semaglutide, which was developed in 2017 or so when we were last time invested, and already then they were talking about the Wegovy pill, and now they are finally introducing it. But I think 2020 2026 could turn out to be a much better year than 2025 for different reasons, but more access, and also the playing field is a bit more level between Eli Lilly and Novo Nordisk because they have now the 7.2 milligram dosage of the semaglutide soon to be permitted to the US market. So it's a bit more level playing field between semaglutide and tirzepatide, and also in terms of the oral medication, the Wegovy pills seems to be, well, probably better positioned than orforglipron. Maybe not so much on the convenience side, but on the effectiveness side. So I think it looks much better than it used to look.
Yeah, it is a company that feels, at least for me, on the edges of my circle of competence. If I take a company like Carvana, I really struggle to imagine a scenario where they're not successful in 10 years' time, just because of all the reinforcing feedback loops. If I look at Novo Nordisk, I think when we originally invested in 2017 or whenever it was, the business was really built on insulin, and insulin felt like something which was a bit like sort of Coca-Cola. It was sort of like maybe an unfortunate analogy, but it was sort of like something that people sort of took and were loyal to, and there wasn't, it was very much a very stable duopoly with Lilly. And the GLP-1 market is obviously very different. It grows very rapidly, which on the one hand is good. On the negative side of the ledger, it attracts lots of competition, lots of innovation, and so it's not 100% clear to me how that plays out in the long run. So we'll have to see whether this becomes a long-term holding. But we definitely thought at the end of last year the markets had become way too pessimistic. Yeah.
Mm-hmm. Yeah, I agree. I'm not so sure that there would be a huge number of competitors. I would still think that Novo and Lilly will be the dominant companies in the field, and then there would be a host of smaller competitors. But that was also true in the insulin space. It was also back then, 10 years ago, not a competition between just two players, but there was also a Sanofi in the business, and there were a few smaller players. So it's always the two big ones and a few smaller ones, and I think it will remain. But like that, even though there are 70 GLP-1s in development, you hear most of them will never make it to the market, and those that will be not differentiated enough to command a huge market share.
Thanks. Can you hear me okay?
Yeah, I think so, yeah.
Okay.
Maybe it's because I'm right next to you.
Yeah, okay, there we go.
It.
It's actually very tied into the question about China and Novo, but it's about risks. Mm-hmm. How do you guys draw the line between acceptable risks and unacceptable risks when you evaluate a new idea?
Oh, that's, I think... the way we think about risk is more in a sort of probabilistic way. I think you can never sort of eliminate risk, but you want to get paid for taking it. And especially, I think, especially a year ago when there was sort of the prospect of a Trump presidency, and like Taiwan was sort of very much on top of people's minds, and the potential for, had there been an invasion of Taiwan by China, then a similar situation could have developed, and similar to Russia after the sort of Ukraine situation developed, and Western investors would potentially have a near total loss of capital. And we saw a lot of differences between the situation in Taiwan and Ukraine. But that aside, Russia is a very small economy, not particularly interconnected with the rest of the world, apart from energy, obviously. The situation in China couldn't be more different. The supply chains are so unbelievably interlinked that we thought that, simple case in point, Apple. Apple would probably not be able to sell us a single phone if for some reason it wasn't able to sort of continue to do business in China. And then a year ago, at a time where a company like Apple, which had a sort of comparable risk to a Chinese company from some kind of Taiwan situation developing, was still flying high on 30, 35 times earnings, and you had all these sort of Chinese companies which were also affected, but probably only moderately more affected than Apple would have been, trading on low single-digit P's and sometimes even below their net cash. And so we just thought we didn't think the risk of some kind of major breakdown between China and the West was a particularly big one, but we accepted it was a possibility, but we felt pretty sure we were getting paid to take it.
Apart from the aspect of being paid to take a risk, which is very important, I think in a concentrated portfolio you have to be reasonably certain to have a rather low range of potential outcomes. You do not want to have a lot of companies that could be zero or worth a lot. And I mean, you can take such bets occasionally, but you will not weigh them with 20% or something like that. So you want to be reasonably certain where the company would be 5 years or 10 years from now.
Okay. Was that the direction you wanted to go with the question? Or?
Yeah, it was. I guess certain risks you can maybe manage through position sizing, or you could wait for a certain price to de-risk it, and then certain risks you just don't ever want to take. And I was wondering if you had any sort of frameworks for thinking about, oh yeah, I'll never accept that type of risk, but that type of risk I would accept through a lower price or managing the position smaller.
Yeah, I mean, there's definitely lots of risks I wouldn't want to take. The important one that sort of springs to mind is I would never want to sort of in any way align myself or invest in someone I didn't trust. I think there's sometimes I see investors investing in a company with a known sort of, known crook sort of, maybe crook is too hard, but someone who's well known for sort of ripping off investors and people will say, yeah, but he's, they think, oh, well, but, the price is low, or he may be a crook, but he's our crook, but that's just not something I want to be rooting for the companies I invest in to win. And, of course, I don't want to be rooting for people doing things in the bad way. So I'm kind of completely indifferent to the price. It's just something I wouldn't invest in. Yeah.
There are things that magnify the range of outcomes, like say a company having a lot of debt. We tend to avoid that, and because they also make bad business decisions if a lot of debt is pressuring them, and also we want to have a good understanding of the moat and its durability. And well, if that's the case, then the range of outcomes is probably manageable.
Yeah. Who's got the mic here? Just here.
Hello.
Hello.
Hi, Rob. I'm Ashok. Thank you for having all of us today. You follow scuttlebutt approach to gain more confidence in an idea, right? So is there some recent example where you followed that approach and you just got out of a bad idea? Can you share some details if you have done something like that?
Sorry, I didn't catch the first.
So you follow scuttlebutt approach to do more research into a company. So is there a situation or an idea where you got so close into investing, but you got out because you found something in that process?
Yeah, I mean, that happens the whole time, and hopefully more. So the question was is a situation I think where we've spent a lot of time studying a company, so a lot of sunk cost in it, and then you find something, and then you have to sort of throw all that research away and then abandon the idea. I mean that happens the whole time. I remember one particularly painful example towards the beginning of my career where there was a Norwegian company which made these stressless chairs, and it was a really high profit, low capital employed business, really, really great, and I'd done a lot of work on it, sort of my expense, my travel budget was quite limited at the time, but I sort of bought this flight to Norway to go meet with the company, and it cost a lot of money, it involved changing somewhere else, and then I think the day before I was supposed to go, the CFO quit and didn't even tell me, so I was potentially going to fly all this way and not even have to have the opportunity to meet with the person I was supposed to meet with. So for me, it was a disappointment. But then I sort of this isn't for me, and actually it worked out quite well because it wouldn't have been a good investment. Yeah.
Was there a recent example?
A more recent example. Let me think, and I'll let Andreas chime in.
Okay. I think it didn't happen to me that I spent a lot of time and then found some particular thing that made me not buy the company. Typically, the facts are confirming the earlier thesis. But what does happen is that I spend a lot of time on a company and then don't quite see it do do my hurdle rate of 15%, which Rob also uses. So I'm not quite sure it will do the 15. Maybe it's more like a 12% compounder, and then I probably move on to the next thing, even though I may have spent already a lot of time. But if the valuation comes down, it may very well go from a 12% compounder to a 15% compounder. So the time is not lost.
Yeah. I think I'll pause there, but if something springs to mind, I'll come back to it if that's okay. Yeah. Mariah at the front.
Hi, I have a question to you about your investment process. So what have you learned this year? Maybe what improved your process massively? And talk about the mental models you are discovering or maybe revisiting this time.
Yeah, thank you for the question, Mariah, and thank you also. I think a few years ago you asked when I was going to speak again at Bob Miles' conference, which was served as the inspiration to go and speak in Omaha at Bob's wonderful conference there. And so thank you for that. And maybe, Bob is one of our speakers tomorrow, so maybe in a roundabout way that helped us to reconnect. So thank you for that. I'm not sure exactly where you wanted to go with that question, but in terms of what we do differently sort of now as opposed to probably not very long ago, it's just AI has just been an incredible booster, I think, in terms of getting up to speed more quickly on more companies, getting much more quickly to what the issues are, which you need to figure out. And, for me, that's been a massive change in my workflow, I would say. I would say most of my workflow historically involved kind of reading about companies, speaking to the investor relations or the company's management, whereas now you can get so much more information, more of a sort of a dialogue. It's almost like you have like a super smart friend who you can just like ask all the questions you ever wanted to ask, rather than just sort of having to go yourself. Now, obviously, I think you do need enough context and knowledge about a company to know where the AI goes wrong, which obviously sometimes happens. So I don't think that replaces going to the source material, particularly the way I invest, meeting physically with the managers that I invest in. But it for sure is a big productivity booster.
Yeah, I would say what Rob just said applies mostly to the initial stages of investing. So how many companies can you briefly look at for 10 minutes and then disregard and move on to the next idea? And I think that was helped with AI. But when it comes closer to investing, I think it's still the old process. You read through the material yourself, you make interviews, you have to build up confidence about the company. And this is, I think, where AI cannot really help you so far, because there's a lot of hallucination going on as well.
Yeah, also, even if the AI was theoretically perfect, I don't think there's a substitute for doing the work yourself and developing your own conviction. Investing is, people always talk about investors being super smart and all this kind of stuff, but the reality is it's not actually a sort of like a battle of intellects. It's a battle of temperaments. And the way to develop if you're lucky, you're born with a great temperament, but in my experience, the way, and whether that was the case with me, I don't know, but the way I sort of develop a good temperament is by knowing the company and above all the people really well where I invest, and that helps me to keep an even keel even when things are going crazy. And also having an environment where I'm surrounded by sort of like a safe, sort of trusting environment. I don't have people telling me what to do, or apart from at home at any rate, apart from in areas outside of investing.
One more thing I may add. So the AI model is trained with the information that is basically constituting conventional wisdom, so it cannot know anything that deviates from conventional wisdom. Plus, it often has outdated information, and that's why I'm also a bit critical of these huge models, because they have learned a lot of things 2 years ago when they were trained, but this is no more recent. and they have all this factual wisdom or this outdated information in the huge knowledge base without updating it. So you have to be very careful to fact check everything that you get from the model.
Yeah. Okay, I think we've got about sort of 10 minutes, so maybe we'll try and up the tempo of our answers, see if we can get as many questions in the last 10 minutes or so. Yeah.
I have the
Alex.
mic. I have the mic. So.
Okay, quick questions, quick answers from now on.
Building trust, how much is the reading, how much is the meeting, how long does it take you normally to build confidence and trust? And second leg is, for how long did you know Carvana or work on Carvana until the crisis happened? And was that time span critical to going through it?
Yeah, so just to sort of adapt the question a little bit, I often get asked the question, how do you, a lot of people argue it's like super difficult to judge and manage a CEO of a company, they're, almost by definition good salespeople, because if they weren't, how on earth would they win their first customer or convince their first employee to join? And to that, I always respond that, there's, if you think about a curve of kind of managers, and there's some like outliers who are very bad. There's the big bulker in the middle are sort of very average, and then there's some outliers on the other edge of the curve who are like super, who are the really great ones. And I think I really sort of just, I'm not the guy who could, if you give me like a room full of 100 managers, can say, okay, divide the good ones from the bad ones. I would be no better than a monkey sort of throwing darts in that situation. But every now and again, you meet a CEO where it's so obvious. It's sort of like a sledgehammer hitting you on the head. That person is doing their life's work. They're not a professional manager moving to the next sort of next paycheck or anything like that. They're just like completely dedicated to really to building their life's work, and that's what I look for. And I would say my hit rate of when I thought I've identified that, I would say it's probably over 90%, probably even close to 100%. And that's not because I'm a genius. It's just because I just just look for these very, very simple situations. Yeah.
When we look at the track record, if someone is new to the job, it's oftentimes difficult to tell how good or how bad this person would be in the job. But typically, they have already been doing the job for many years and have a paper trail. And one more thing, what also you look for things that impress you about the person. For instance. I saw a company acquire another company, and then the CEO, including his whole family, relocated to the place where this acquisition company was located in order to make sure that it's very well run. And in general, when you look at companies, they usually have the highest market share in a perimeter around the headquarters. Why is that? Probably because information flows much more efficiently to the top management of what happens around the headquarters, and some faraway area doesn't reach management with the same, only through filters. And this has impressed me a lot, that this manager was willing to relocate his whole family to Paris in this case, and make sure that this acquired company is doing well.
Yeah. Okay, we're trying to up the tempo even more. Water.
Rob, just quickly, when I first met you, leading on from that, your filtering criteria were founders that were involved in the company that met your, call it ethical criteria. Is that still your filter? So I'm saying is everything you own, founder-led, owner-led, where you buy into their philosophy and their, call it, ethics.
Yeah, I would say that's very much the sweet spot. It's not always the case that there's the founder running the company. But what I do look for, for example, Credit Acceptance is a company where the founder wasn't involved for many, many years. But I do look for people at the company who have that sort of sense of ownership. So they effectively behave like a founder, as opposed to more of a sort of professional manager who's sort of every 5 years changes to the next opportunity. Yeah. Is that? I can't see.
Yeah. Sure. Thanks for taking my question. There are obviously a lot of biases, psychological biases in investing, endowment bias, confirmation bias, recency bias, etc. Which ones are you most, alert to, and how do you deal with those?
Yeah. So the great sort of Charlie Munger always said, invert, invert. And I think there's obviously been a lot of work done on behavioral finance and all these sort of biases we have and how they lead to sort of irrational decisions. And I think the conclusion a lot of people took away from that was you have to somehow try and eliminate this sort of emotional, sort of irrational, in inverted commas, side of the brain and try and be this sort of objective, sort of calculating machine. And A, I don't think that's possible. But B, I think a lot of our emotions can actually be harnessed to make better decisions. And the most important one there is actually liking someone. I think as humans we've evolved to very quickly form a view on whether we like someone or not, and that might be described as a gut decision, but there's like hundreds of sort of signals and patterns and all these things going on in our brain to sort of come to that very quick conclusion, which oftentimes can be a matter of life and death, misjudging whether you like someone or not in an extreme scenario. And so I think that's provided you have the right sort of values and you live the values that you're looking for in other people. I think finding that you like someone is an incredibly powerful indicator of so why on earth would you try and eliminate that from your repertoire? So I think that's how I think about it. Yeah.
Well, I don't think I have much to say.
Okay, good. Okay, how are we doing? So we've got we've got about five more minutes. So hopefully 2 or 3 more questions.
So Rob and Andreas, I think we know each other for more than 17 years or something, and we met in that room in Omaha, that famous one.
Yep.
And I know you as very independent thinkers, and my question, and also the way you do your investments is, I believe, very independent. But I'd like to get some color on how you work now. Now you've worked together. How does that working together actually work in your day-to-day business, in the day-to-day lives?
Yeah, it's a lot of fun. So I would say structurally how Andreas and I work together hasn't changed. On the investing side, we do obviously administrative stuff, which is maybe not so interesting for here. But on the investing side, we always love to talk with each other. We would meet, I know, once a month, exchange ideas, and we were often very aligned in the way we thought, but sufficiently different that we'd have differentiated point of view. So it was in that sweet spot of being different enough that the discussion is interesting, but similar enough that you're sort of starting from a similar sort of place. And the main thing that's changed since Andreas joined RV Capital is that we do that now probably every day. Probably 2 or 3 times a week in person, where we work together in the same office, and on the days where we're not physically together, we're speaking multiple times a day. So it's just sort of, I would say the volume of our contact has increased a lot.
Yeah. Each one looks at what interests him separately, and then discusses this with the other person who may like it or may not like it, and each one comes to his own conclusions and his own decisions. So it's not that I'm too much involved in managing the fund at all. It's all Rob's decisions, but the decisions he takes, he usually passes by me and wants to know how I think about it, and try to give my input. And same is true for the ideas I look at.
Yeah, we don't have a committee approach. We both have our own pools of capital. I buy the things that make most sense to me, and Andreas does for him. And there's some overlap, but there's also stocks which one of us owns and the other doesn't, or vice versa. And it's not normally because we think the idea is stupid. It's just we maybe see things a bit differently, or have a better idea somewhere else. But we don't make decisions by committee. And I love to hear Andreas's opinion on stuff, but I don't run my investment decision by him, not because I don't value his opinion, but because I'm sort of want to make sure that when I make an investment decision, that it comes from an inner conviction and not from someone I respect enormously telling me they think it's a good idea. So it's more for my own sort of protection from myself as opposed to protection from Andreas's point of view. Okay, so we've probably got time for, we're on the hour, so we'll take one more question and then we'll head off to the mountain. Georg.
Hello. Yeah, you answered my original question just now before. I wanted to ask you about the state of your business relationship or business marriage with Andreas, because FINMA forced both of you to find a mating partner, and luckily you chose Andreas, and by sheer coincidence, Andreas chose you. So the final question will be, are you planning to have children?
Great question. So, but Andreas and I are both allergic to hiring people, coming from a slightly different position. I'm sort of allergic to hiring people because, not that there's not lots of wonderful people out there, but I hate the idea. I love investing and visiting the companies, being the guy that gets to travel to Phoenix and meet with people like Ernie. And my worst sort of nightmare is sort of becoming more of a sort of a CEO of an asset management company, and then other people. Getting to do that work while I sort of get to sort of, do all the boring stuff. So that's where I come from. Andreas is potentially similar, but Andreas has the added feature that he's also very, very frugal. So every now and again, we'll be doing something sort of tedious like, filling out some form or something like that. And I'm like, Andreas, wouldn't it make sense, to get someone else to do this for us? This isn't, we're probably not adding a whole lot of value doing this task. And Andreas will always respond, don't worry, I can figure out a way to code it so it's done for us automatically. So if you ever want Andreas to code, if I ever want Andreas to code something for me, I'll just suggest hiring someone to do it, and then it's like, it's done the next day.
No, in terms of children, we're not going to have products that we manage together, so we will be separate. Rob will manage his fund and his customers, and I will do so with mine. We will try to keep the structure as simple as possible so that we're not so much involved in managing people, but getting things done and have as little bureaucracy as possible.
Yeah. Well, thank you for that question. Well, thank you everyone so much for your attention, for the great questions, for the enthusiasm. When I stand up here and we see so many eyes full of passion and energy, it's really a privilege to sit here and command your attention in these days where there's so many things that command attention.